All right, it just started. Okay, you probably noticed that the recording from last week was just put online on Wednesday, maybe. Okay, I was sent somewhere else. It didn't send to my media, so I actually had to talk to the IT, and IT actually worked to put that onto my account. So somehow, I don't know what I did wrong, or somehow something's wrong there. But anyway, I think this time should work. Hopefully we'll have everything. And I actually have asked for the batteries, so I still owe Jane 2 batteries.
You got it back.
You got it back? But these were actually used a little bit. But anyway, I asked the department to put some more here, but still not here. I might have to go out there and then buy a few. All right. Okay, sorry we have to be here. You cannot go trick-or-treating tonight. You know, so we still might have some time, right? If we finish early enough.
I work early tomorrow.
My son's at home crying because I can't go.
Oh.
I'm just kidding.
Yeah, I know.
He wouldn't go anyway.
He's gonna go anyway. That's too young, probably.
No, it's not he's too young. We just don't ever talk to him about it, so he doesn't really know what's going on.
How old is he?
He gets up to the day and he's like, what are people doing in costumes? We're big doing
Yeah, well, yeah. I used to go with my kids, but now my kids are just too old. Yeah, so they're not going out anyway. Anyway, so my daughter actually is home and handing out the candies. So I might just, sort of dress up and then get some candies when I get home. Okay, all right. Let's see here. Oh, before I get started on this one, there was one concept that I probably need to talk a little bit about it. And also David sent me a document and everything. It's about the reserve replacement ratio. Right? By definition, we know that it's supposed to be equal to the added reserve, the increase in reserve, right? Whatever the newfound reserve divided by production. Okay. And I said something about finding the difference between this year's and last year's and divided by production. But the difference, of course, is not going to be just the difference. We need to add the production back into the difference. Then that should be the same, right? Basically, the idea is whatever newfound reserve should be enough to cover the production amount. Therefore, you're going to be able to keep the production going for some time, right? So that's the idea of using the reserve replacement ratio to look at how much new reserve we actually have. I mean, it's just a different way of calculating it. But that's just the basic idea. I think pretty much everybody got that. I did see that maybe 1 or 2 people used just the difference without adding back the production. Therefore, you came up with the reserve replacement ratio 0.0 something, 0.06 or like 6%. So we need to add back the production to that. Then it should be the correct way of doing that. So just a little bit I want to mention here. All right, a little bit of a review of what we went over and the outline, of course, why we are doing this. So I think that probably put that in perspective might be a little bit helpful. Any questions before we go on? Comments? All right, if not, basically this unit, right, has been talking about the valuation of the stocks, valuation stocks. There are several different ways of valuating stocks, right? Using ratios, using multiples, or we can use stock price, and then look at the intrinsic values, and also the dividend discount model. So we'll be using several of these. I want to just go over that very, very quickly about what we did last time. We said we actually can calculate the expected return from the expected return formula. We actually can get the price, right? So this is kind of like using that kind of formula to get the price. So stock price multiplied by these shares outstanding, that would represent the market valuation of the common stocks, the value of the firm. So this is what we call the dividend discount model, right? So this is one method of evaluating the stocks. Okay, so we have that, and okay, this again is one of the formula we use to evaluate the stocks, right? The price, and then this is including a growth in the dividend growth rate. So if we put that in there, then that certainly would increase the value of the stock as well, because that the company may change their dividend policy. Therefore, there will be a dividend growing at a constant rate. So how that's going to affect the stock price or valuation of the firm. That's a little different from the constant dividend model. Right? So this is a little bit of a variation. All right, so we actually have one example. And what we talked about next was to add another one here, right? Is a pullback ratio. All right, so change that. We have a little bit of a, we'll have one more example. Then we talk a little bit about whether the stock price valuation of the model is good enough. Right? Basically, the first one we were talking about is rely on the stock price to evaluate the firm's stock prices or the firm's value. But then what we talk about is, well, there are some kind of problems just using the stock price to assess the value of the company, right? We said, well, because of some kind of anomalies, so we talk about anomalies, right? Market anomalies and several of these, things that we noticed in the past that may explain, might suggest that the market may not be totally efficient. Therefore, relying on the stock price to evaluate the firm's value may not be entirely reasonable, right? So sometimes you may find the stock might be undervalued or overvalued. So we need to look at some other things, right? So that's something we were talking about. Then we talk about some of the guidelines for evaluating the stocks, and especially like look at the stock prices. We'll also look at the net book values. The next topic we'll talk about is essentially look at the book value, right? So that's the second method. And if we use the book value, how are we going to be able to evaluate the firm's value? So we'll talk about how we actually can estimate the book value. You can't have a book value just from the book value equals or the owner's equity equals the common stocks paid in, surplus plus retained earnings. You can look at all these things, but then we have a lot of adjustments, right? You can actually add a lot of adjustment to that. Then you're going to use the book value multiples, like what we said here, right? The appraised value of ONG companies is often 1.5 to 3 times book value. So afterwards, what we went on to discuss was these are some kind of multiples, was how we actually can adjust the book value, right? Adjust the book value by several things. So we went on several details to talk about adjust the book values. And I think the last thing we were discussing before we finish it was the deferred tax, right? Deferred tax. Okay, deferred tax actually would affect the book value of the company. Right? It would affect the book value of the company. How that's going to affect it? Actually, we use one example, and typically I think there's like 50% of this deferred value. We're going to subtract 50% of the deferred tax as the adjustment to the book value.
I have a question about paid-in surplus. Can it be negative, like market value is lesser than face value?
The paid-in value, usually it is possible that it could be negative in the sense that, which means that the stock price actually, whatever the value, the stock price actually went below the book value. Yeah, the face value of the stocks, typically. I mean, theoretically, it could be possible, right? But generally speaking, that's, typically when we are talking about the paid-in surplus, it is at the time when you actually issue the stocks or, the seasoned stocks, things like that. Typically, it should be a positive number, right? Because the face value is typically very conservative. In that sense, then the face value of the stock is set very, very, very low. Right? It's like, sometimes the 1 cent or something like that. You typically have a positive paid-in surplus. But theoretically, it could go negative. But typically, it's positive. Okay. How are you doing?
I'm here.
Everything okay?
Yeah.
Excellent. So good to see you here, actually.
Thank you.
All right. So, and then we were talking about the adjusted book value, right? By looking at where is that slideshow? Okay, here. All right. So we actually went over this example as about the deferred taxes, And this actually is due to the accelerated depreciation. By the way, a lot of times the government actually uses the accelerated depreciation as a policy to encourage certain behaviors, especially if you really want to invest in certain sectors and then we don't have enough investment. In that case, then the government actually might just provide some of the financial incentives, including the accelerated depreciation. Right? In that sense here, as we went over that, then the thing is that, as a matter of fact, the total amount of tax the company has to pay under these two schemes are the same, right? It doesn't matter. If you look at total amount of tax, it's the same amount. But the timing of the paying the taxes actually would matter. So the difference actually is due to what? Is due to the time value of the money, right? The discount or time value of money. Because tax paid at a later time doesn't worth that much as the same amount as we paid early, right? $75 paid today versus $75 paid down the road. These amount will not really be the same, right? Because the present value of tax we pay later on is equal to pretty much very, very small, right? In terms of today's value. So that is the idea behind the deferred tax. Therefore, we actually have to take out the deferred tax amount, right, partially from the book value. That's why I said typically the rule is just subtract 50% of the deferred tax, right, from the value, the book value of the company. Right, so that's what we were talking about. Right, so I think this is a slide we probably stopped at. Now, deferred tax is not a debt, but it has potential impact on income, right? Okay, let's say eventually be paid off. So the third bullet point is the major difference, because you can pay it in the future, and then that essentially is equal to a very small amount, negligible amount. Deferred tax with book value for quick analysis, going concern analysis. All right. And one example, actually, the last one was that 1989 Arco balance sheet had a $3407 million or $3.4 billion in deferred taxes, shareholders' equity equal to $6.562 million, right? Treating only half of deferred tax as a liability increases the equity by 25%, right? So this, of course, we're looking at 50% of that. 50% of 34 or 3.4 billion is about a 1.7, which is the amount to almost 25%. Right, 25%.
Sorry, can you repeat that? How it increased equity by 25%?
Well, think about this. The shareholders' equity is 6.2. Okay, they actually have a deferred taxes. Usually, we treat that the deferred tax as like 50% of these deferred taxes, right? So if it's $3.4 billion, 50% of that is like a 1.7, right? $1.7 billion. And then this is like 6.5, right? 1.7, 4 times 1.7 is 6.8. 6.8, something like that, right? So that's the amount to roughly about 1/4, right? That's 25% of the equity amount. The reason is that deferred tax, if you don't really deduct that, right? If you do not deduct that, then this actually the amount. For example, this is your book value, supposedly, right? This is your book value. But as a matter of fact, you actually have a deferred tax. So you will have to pay that later on, right? You're going to have to pay that later on. But this amount actually, you are not paying the total amount, basically. You're going to have to pay something like the 50% of that. That's basically the rule of thumb that we use, right? So that just means that your tax liability is equivalent to about 1/2 of the $3.4 billion. Okay, $3.4 billion, which is about 25% of that equity. That increases your value by 25%. Because you don't have to pay that $3.4 billion, right? Even though the total amount is equal to that. But the present value is not equal to $3.4 billion. Make sense?
So on the balance sheet, it actually reflects, it says deferred taxes.
$3.4 billion.
So how is it treated as only half? Where is it?
Oh,
Where is that reflected?
well, because typically when we actually evaluate that, right?
Okay.
Because you have this much, eventually it's going to pay it off, right? But the present value, we're talking about present value. The total amount here is 3.4. You don't know when, for example, it's going to take a long time to pay that, right? The total amount you're going to have to pay 3.4. Suppose that we'll move all the $3.4 billion all to 20 years later, for example, right? So the 20 years later, that $3 billion is not going to worth that much today.
Right.
So that's the point we're talking about. Typically, we treat it as 50% of that. So the present value is 50% of that $3.4 billion deferred tax.
Wait, I thought treating only half of deferred taxes as a liability meant you're only paying half of it now, and you're deferring the other half to be paid for later.
I do not think this is what that meant, though. Okay, what that meant is that you actually have this much of deferred tax, right? But the total value of the deferred tax, the total amount of tax you're going to actually have to pay, is treated as 50% of that amount. It's not you are paying that now. It's the value of that deferred tax is equivalent to 50% of that, the amount on the balance sheet.
So where would that be communicated to shareholders as far as the fact that on the balance sheet it says that we have $3.4 million or $3.4 billion deferred tax, but here's the actual present value of that, and that means your shareholder equity is that much higher.
Right.
How is that?
I mean, typically when the analysts are looking at the the financials of the company, when they look at that, they understand this is the implication of that. And for example, if we're looking at the financial statements, right? By looking at that, we kind of understand. Now, basically, if you are looking at 6.5, that's shareholders' equity. Suppose that we can actually subtract the liability. It's not really a liability, right? But if we treat that as a liability, it is. I mean, it's not that, but it's a kind of liability, tax liability, right? But if we treat a total amount, that just means it's not worth that much then, the company's value, right? But actually, we are not going to deduct the total amount. We just have to deduct the 50% of that. Right? So in that sense, that we understand that increase the company's value by a certain amount. Okay. All right. Okay, let's see here. We are talking about ONG properties, and we can look at that later on, especially about acreages, how we're going to be able to evaluate the acreages, especially. All right, there's another one here we need to talk about, is the amount of investment in the stocks, because sometimes the company actually could buy, another company could own a substantial amount of stocks from another company. Right? So this is something related to something we call the minority interest. All these things. This has something to do with the bookkeeping. So when you look at that, we try to understand what that means, because this again has something to do with the book value adjustment. Right? Because as we said, if you try to use that 1.5 or 3 times the multiple of 3, right? If you come up with the book value, if the book value is not very accurate, then you are either underestimate or estimate the value of the company, right? So in this case here, the one complicating factor is the long-term investment in the stocks, right? So this is how we're going to be able to treat a long-term stock investment. You own 50% more or less, right? So we have actually 3 types of these ownerships. One person is less than 20%, okay, less than 20%. So basically, we value that as the investment on the balance sheet at the lower cost of market value, or lower cost, or market value, right? So whichever is lower, whether it is the cost of the investment at the time you purchased, right? Or just use whatever the market value is, as long as it is lower. So this is how we actually treat that. Right? So that's less than 20%. If it's 20% to 50%, okay, we have actually some kind of method to treat that. If we have more than 50% controlling interest, then basically companies actually have to prepare a consolidated financial statement, because a lot of times when you actually look at the 10K report, right, you probably notice that there are some kind of consolidated financial statements, right? Consolidated income statement, consolidated balance sheet, right? What does that mean? That essentially means that the company, one of these, you actually have more than 50% controlling interest. Therefore, they're combining these units, right, financial statements as one single statement. So there are some complications in this case. So how are we going to deal with that? All right. I think this is just some basic understanding of the long-term investment, I think I'm going to probably skip this a little bit and then move on to another one there. Yeah, this is the one we're going to have to look at. All right, this slide. Just pay a little bit more attention to this slide. The previous one, probably can kind of ignore that. All right, basically what happens is that if you have non-controlling interest, all right, and accounting entry for such investment may not represent the actual value of the interest held. All right, we're going to see that. Okay, what I mean by that. All right, we're gonna look at that. Consolidation and minority interest. I'll look at an example here. I probably can illustrate the point. When a company owns controlling interest of more than 50% in another company or subsidiary, so we are looking at more than 50% here. Now, the financial statements of both companies are consolidated. Essentially, you're going to actually see this in the consolidated statement, financial statement. All right, look at an example here. We have a parent company owns 80% of subsidiary that has a book value of $200 million. All right, so you have 80% of this. The total asset and liability of the subsidiaries are consolidated with the parents. So you're going to see the total amount of asset and liabilities showing up in one's financial statement, right? Okay, but the parent company must account for the 20% that does not own, because we said the company only owns 80%. So you really don't own that rest of the 20%, right? So what are you going to do then? Essentially, that 20% is what we call the minority interest. All right, you're going to put that in the minority interest part. Right, so it is a liability. Why is it a liability? Because when you actually have consolidated the financial statements, that's sort of exaggerated, right? You inflated the total amount of asset that the company actually has. Right? Therefore, you will have to take that out from the statements. That's why we call this the minority interest, because there's a 20% of the interest that the company, the parent company, doesn't really own. Right? So it is then treated as a liability. This is basically the accounting rule. Why is that? I mean, this is just accounting. Yeah, accounting. So when we look at that, we understand what that minority interest item is. Right? So in that case, if we are looking at the total asset, for example, right? If you look at the total asset and liability of the company, and it shows like $5 billion. But as a matter of fact, the company is not worth $5 billion, right? Why? Because there are certain amount that shouldn't be counted for, right? It should be, take out the minority interest in that case. So that's one part of the adjustment. One part of the adjustment. Okay. So sometimes the minority interest are line items that cause significant uncertainty for the assessment of values, leverage, and liquidity. Let's see here. One of the things that we usually have is that we don't really know what portion of the reported cash position is owned by 100% subsidiary and what portion is owned by 15% subsidiary. In that case, then, in the general financial statement, we really do not see that. Right? We do not see these two items clearly. Right? So that causes some kind of uncertainty. Okay, so if the subsidiary has a negative book value, the entry may look more like an asset. So originally, as we said, if there's a minority interest there, is positive book value, we actually subtract that, right? But now if it is a negative value, subtract the negative value, it looks like a liability. I mean, like an asset now, right? All right, so for example, subsidiary net income $10 million, and it's 80-20%, 80% and 20%. So basically what we are saying is 20% or $2 million, 20% of $10 million, right? 20% of $10 million, which is equal to $2 million, will be deducted from the company's income statement as minority interest. Okay, minority interest. So again, this is about one of the adjustments, right? An adjustment we have to have. In terms of adjustment of the book values, we have to consider other things like the licenses, patents, and franchises. All these are general principles.
Dr.
Yes.
Can you please go back to the previous one?
This one here? Yes.
Yeah, so if it's a concern that you don't know what portion is owned by the subsidiary, then, isn't it easy to just say that 20% that's the minority interest and that $2 million belongs to someone else, right?
Yeah, in this case here, if we do know that 20% of these are the minority interest, we can take that out, because in this case the net income is pretty much sure, because we already know that's 20% of that.
But
for
since
example,
you have your income statement know what percentage of whatever company.
Sometimes when you look at the cash flow, stuff like that, you don't have a detailed, the cash flow amount, for example. This, for example, like this part here, look at, for the income part here, if we know the percentage, usually we know that, right? The minority interest amount, in that case, we don't have an uncertainty. But some of the things that we actually have is, as we said, the cash position, we really don't have that, listed there. We don't really know how much actually belong to the minority interest or some other thing. If it's not minority interest, for example, the minority interest, of course, is like less than 50%, right? But what happens is not less than 50%. It's more than 50%. Now it's not listed as a minority interest in that case. Then we might have a little bit of a hard time understanding clearly how much is going to be attributable to the the part that doesn't belong to the parent company. So there could be a little bit of uncertainty there. Okay. Because financially, they actually have to report consolidated financial statements, right? They don't have to look at it individually. They could have a little problem. Let's see here. Let's see. That should be fairly straightforward. Okay. There are some off-balance sheet items, assets and liabilities, so sometimes we have to consider that as well. Off-balance sheet, right? It's not listed. All right. So what do I mean by that? One of these things is long-term lease. Okay, long-term lease. The long-term lease are not listed on the balance sheet. Therefore, that certainly would affect the company's financial situations. Now we need to be careful about this. You just have to dig a little bit deeper and find out the financial conditions, change the financial condition, results of our operation, liquidity, capital expenditure, and there could have some of this. So you really can't just look at the balance sheet alone, right? You have to look at some of the declarations, right? So look at some other parts in order to find out, right? But we're not going to go into the details of that. It's just as a principle, because if you really want to do that, you really have to get a lot of very much detail. This is why we actually have some of the companies that specialize in the valuation of especially certain type of industries. Because if you are not doing this particular job, then a lot of times we don't totally understand, right? So that's why we really want to have a specialized, sometimes specialized valuation companies to do that. Okay, so the specialization in that field actually can be pretty important, right? Even though sometimes we know the general principle, but as far as the details are concerned, sometimes we actually have a little hard time doing that. Okay, this one here, tax is again, there are some kind of implications as well. So we may have to make some adjustments, right? Tax loss carry forward and backward. This is kind of like the personal income tax. We know that if we have losses, right? Sometimes that we can carry forward or carry backward, right? So in a business situation, if we have tax law, we have loss, you actually can carry some of the loss forward and backward, right? So these are some of the general rules, okay? For example, operating loss can be carried back and applied to income in the preceding 3 years, right? 3 years. So if we are looking at Chesapeake, for example, they actually have some kind of operating income loss. Now what happens then is they can go back, right, offset their tax liabilities from the past 3 years. And if you still have something, going over that part, you can actually apply that part to the future tax liabilities, can offset part of the future liabilities. So the remaining portion can be carried forward 15 years. Right? So there are some implications there. Can tax loss carry forward be used to offset the taxable income of acquiring company? Now what we are saying is that you are acquiring another company, right? Can you really offset that? The general answer is yes, you can do that, right? But you need to get approval first, get an advance ruling. All right, so let's see here. Let's look at an example. Previous year's net income is $35,000. This year, actually, we had a loss of $20,000. Okay, we had a loss of $20,000. So the loss applied backward would be 35,000 minus the 20,000, right? Which means that we actually have a 15,000. So that just means your tax liability will be reduced, right? Will be reduced. The amount that you're going to have to pay is only pay 35% on that 15,000 amount, right? You don't have to pay any tax on the loss, right? A loss. So that's what we call the loss carry forward, tax loss carry forward.
So it's
backward.
retroactive, basically?
Retroactive, you can do that, yes, in that case.
But how would you do that for 2 years before? You've already paid your taxes.
For example, in this case here, right? For example, we set the previous net income. Previous year's net income is 35. Okay, suppose we keep that condition there, right? Keep that 35. But then we have a loss of 75, for example. If you have a loss of 75, and then we use previous income, which is 35,000, right? So we actually have an amount over that. So we still have 35. So 35 can be applied to a year before that. If it's still over the previous year's, right, income, then we can apply that to a year before that, the third year. And you still have something left over, then you can apply to the future, for the future 15 years. So that's what, what I can do. I mean, it's just a rule. I'm sorry?
No.
Okay, so the pension programs, stuff like that, we definitely need to consider those as well, right? Because this is part of the liability. We've got to be careful about that. You really can't just say, well, just look at the net, the liability and an asset, and we do not consider other things, because the pension program can be a substantial amount of liabilities. Especially a lot of times, we understand sometimes when companies are filing the bankruptcy, right? Okay. Why do they file for the bankruptcy? Like just an adjustment, right? Try to do that. One of the things they try to do is try to get rid of the pension, right? This kind of liabilities, because that could be like last time was that American Airlines. Is that right? Last year? Which company was that? I think the American
Airlines.
Yeah, American Airlines, right? American Airlines filed the bankruptcy, right? Proceedings. Then what they would like to do is essentially try to restructure, right? Restructure debt, restructure a lot of different things. In that meantime, if they do this, what happens then is, if they don't have the agreement, right? They could, of course, negotiate some kind of program agreement. If they don't have that, basically means those workers, right? Their retirement plan will be completely wiped out. Right? So sometimes when the unions are negotiating this arrangement with the management, they got to be very, very careful. You just don't want to ask too much, right? If the company files for the bankruptcy, then you're actually going to incur a huge amount of loss. Right? The retirement amount is going to essentially be severely impacted. So we are talking about two kinds of programs, right? Basically, three types of pension programs. One is defined benefit program. Defined benefit program is essentially the company contributes a certain amount. Okay, and then at time of retirement, you get a certain percentage of your, say, income back, right? Like 75%, depending on the number of years you worked, depending on your salaries before your retirement. For example, like OU, right? Look at the OU retirement. The programs, actually there are several different kinds. One is, of course, is what I call defined benefit, right? So if you can retire according to the rule of 90. Okay, used to be a rule of 80. Okay, what does that mean? Rule of 80. That means that you can work for a certain number of years. Okay, so the number of working years plus your age, if that reaches 90, then that just means then you can retire to receive a full benefit. Right? If you retire early, you probably can have reduced benefit. Right? So if you look at some of the professors here, the rule of 80, which means if they start to work at the age of 30, then they have to work 25 years. Right, 25 years working, and the plus 25 years the age progress, right? So that's 50 years. 50 plus the original 30, that's 80, which means then they can retire at age of 55. I know some of the people they essentially retire around about 50 or something, 55 or before 60. Why? Because they actually were under the rule of 80. In that case, then you can get a pretty big proportion. Sometimes you can reach your salary of 75% of your final year, 75%, 70%. That's a pretty substantial amount. Right? This is what we call the defined benefit. Right? Defined benefit. So that's the amount. The second one, of course, is defined contribution. Now, defined contribution is a little different from the defined benefits. What is the defined contribution? Oh, you guys probably understand, right? Huh?
401k.
401k is, but this is sometimes we call the cash, balance. 401k, kind of like that, right? In the sense that actually the company contribute a certain percentage, and if it's invested, then that's yours. So 401k you can say is part of that, cash balance plan, right? And that just the employers portion of 401k. Okay, and other part you can view that as employers part. The employees certainly may contribute part a certain amount to that as well. Anyway, so that's just that could be sometimes could be a liability, right? Because you have more people join from the pension program than people contributing to that. So you actually end up with a negative amount. Right? So one of the things that people are talking about is the OTRS, Oklahoma Teachers Retirement System. Right? We could have big holes in there, right? We have actually big holes in it. But more people join from that than the contribution. Okay, some other kinds, liabilities, really sometimes you have to consider those golden parachutes. All right, so sometimes that can be pretty big, right? Pretty big. Environmental liabilities, that's pretty understandable. Right? Sometimes that could amount to billions of dollars, right? Several $billion, like last time the BP, right? The spill that cost the company several $billion. That is the kind of a liability that they will have to consider, especially we're talking about the E&P companies. That is one part of them. And DR&R, dismantlement, removal, and restoration, that we need to take that part into consideration as well. So some of the little detail stuff. Okay, and this part here, DR&R, abandonment, and one last bullet points. Gulf of Mexico. Basically, what we can do is you really don't have to clean up like what you do off the shore, right, of California. Right, you just simply rig to reef. You just have to reduce that cost quite significantly. Otherwise, in other places, then it's going to be a lot different. Okay. I think that's the last slide. No, we have more. Okay, we have more. How many more? Last one. Okay. Oops. No, I do not mean that. Okay. So the last one, drilling commitments. So for drilling, so this actually could be some kind of obligation. So we need to take this into consideration as well. So these are just a few items there. Again, I mean, this is kind of like a cursory overview of some of these things. We really haven't gone into the details, like look at the numbers, stuff like that. And I think probably it's not necessary to go through that, as long as we understand the principle. So as far as, so you're going to probably ask me how you're going to be able to ask questions, right? How am I going to be able to ask questions? I'll probably, if I ask questions, it would be kind of very rough, all right? On this, kind of not very much detail like this, of course. I mean, it's hard to do things like that. So I'll probably just have a few general type of questions related to this formula, right? Dividend discount models, okay, and growth models, these kind of things. For those, I may just have a few simple items. You need to look at the book value, make some adjustment, and then use the market, like multiples, and then try to evaluate. So, and it's kind of general. All right, guys. All right. Okay, let's go to a different section. Okay, different section is pretty short. All right, I have set everything there onto the DTL already. Now this part here is about a segment valuation. Which second? This is a little too early. I have another one, I believe. Competitive comparison. All right, competitive comparison. Now we look at the segment valuation, and again, we are not going to be able to look at some specific examples, but we just need to sort of go over mostly principles. Okay, principle. Competitive comparison. Do we do that? We do that a lot, by the way. Okay, in reality, right? We always compare to similar industries, companies in the same industry, and try to find a valuation of a company, right? Because many times you can look at the market fundamentals and then the company fundamentals, but in the meantime, sometimes people just don't have a very good feel about what those things are, and then they look at what's the recent transaction, right? What happened in a recent transaction? Then we're going to look at that. If the companies are similar, then we're going to say, well, they should have the same or similar kind of valuation. Right? That happens. We can look at that. Okay, we'll look at some of these things, especially when we come down to For example, say acreages, for example, right? I look at acreages. Now we're going to specifically talk about how to evaluate acreages. But a lot of times, you know, you have the same acreages, the same area, right? This year versus next year, and the prices are going to be substantially different, right? Okay, so if you look at the company fundamentals hasn't really changed that much. And then you also look at the industry situation, hasn't changed that much. But the prices simply went up, right? Because we have more recent transactions. And the more recent transaction actually represent a higher price. Now in that case, what are you going to do? Well, a lot of times we just look at the comparables, right? Look at the comparables. Then this is what the price is. Then we're going to charge the same price. We're going to essentially sell for the same price. This is why we probably we need to look at the competitive comparison. We're going to look at some of these. So it's a general principle. And why we need to look at a competitive comparison? Several reasons, right? Institutional investment, individual investment, employment. So we need to look at these things, all right? The more important thing, the very important thing in this kind of comparison is the benchmarking, right? What is used as the comparable group, okay? Comparable group, right? Benchmarking. So you're going to have to actually have a benchmark to compare with. Right? So we need to look at the whole industry and the sector. And let's see here. And because sometimes if you isolate out this particular company, right, we're not going to have a complete idea. That's why we need to compare to others, right? So, and also sometimes we'll look at the benchmarking. Benchmark we actually, this is used for the merger and acquisition, right? Because how do we know the company is underperforming or the stock is actually undervalued? And we just have to look at similar companies, right? When we look at that, then we actually have a much better idea. So the merger and acquisition uses this kind of thing quite a bit. All right, so in the benchmarking, how do we identify the peer groups, right? So we actually have different sectors, different industry, right? If you look at a sector, it is the energy. But in an industry, we have several different kinds. We have integrated O&G companies. We have E&P companies, right? We actually have equipment services, drilling, refining, marketing, transportation sectors. We actually have utilities. So you just look at each one of these and then put these firms in each line. One of the things that we can do is look at the value line, right? Value line actually group the companies in each of these categories. Then if you use that, because that's commonly accepted, so if you use that as a peer group, I mean, people usually wouldn't really ask that much of a question. Right? Now, for example, like utilities, one example you might remember is that when we were calculating cost of capital, right? When we were calculating cost of capital, how do we calculate cost of capital? One of the things we usually do is to select a peer group, right? A comparable group. Now, remember, there's one example I showed you. Actually, I listed about 6 or 7 companies there, right? 6 or 7 utilities. Now, we directed that number. I just got this number from value line, all right? Value line, because that tells us what the peer groups are, right? In that case, then you can use that. People really cannot say much about it. Of course, you might need to make some adjustment because, especially for utilities, the pure gas utilities really don't have a lot of pure gas utilities because sometimes you may have business in gas, you may have business in electricity, right? So if you are comparing the cost of capital of a pure gas company, then you got to be careful. You really cannot include the the electric company, right? So in that case, then you end up with a very limited number of pure gas companies, right? Pure gas utilities. But then there may not be comparable because some companies may be very big, some companies may be small, right? So in that case, you will have to make some adjustment. So that's just kind of a little bit more detailed. All right. So the size, we know how to look at that. We already know that. And let's see here. Size company will look at the reserves, asset, capitalization, employment number, customer number. These things are some of the typical kinds of. And I think the most, something the revenue, right? Revenue amount, right? So especially when we look at the utilities, you have to look at the number of customers, right? Look at the number of customers, and that seems to be a pretty big. Category that we compare. Okay, the market or location, that's by market or by location. All All right, that's one. Other factors, environmental and social factors, how you can identify that, whether this is new or it's been there for a long time, whether there's a litigation going on at the time. So basically what we're trying to do here is try to compare some of the factors that actually enable to compare your particular company to the rest of companies in the industry or the sector. But let's just face straightforward. I'm going to go over this very quickly. Okay. Comparison criteria, know the company or the product services that offer, the marketing, and the regulatory environment. All right, so the regulatory environments can be very important. Okay, environmental issues related to or some of the social issues. So, all right, you just have to justify. Okay, you have to justify your peer group, right? And so these are the things that you really have to look into. All right, that's not a big deal. All right. So I think we need to probably go over some of these things here. Okay, it's kind of some of the specific concerns, specific factors that we need to look at. Right. All right. So integrated oil companies. Right. Integrated oil companies. Some of the important factors, some of the important things that we need to consider is finding cost, the reserve, the production. So you have to pay special attention to these factors. Right. Equipment, technology experience, all right? E&P, acreages, right? These reserves, these are very, very important factors, right? These are the most important factors, pertaining to the E&P industry, right? Drilling, the rig count is going to be very important, okay? The utilities, the feedstock costs. Feedstock basically means that you have to look at whether the gas price, right? The oil price, if you actually have a well, use that the power plant. Okay, gas or that's what I meant by the feedstock cost. Okay, number of customers, right? Customer mix. Do you really have large percentage in the residential customer? So mainly you serve the residential customers, or mainly serve the commercials or industrial, right? So now that kind of thing you tend to determine whether these companies are directly comparable. Okay, regulations. Because sometimes the regulations will be different. The investor-owned versus the cooperatives, right? The investor-owned basically, profit maximization, right? Seek the profit is their objective. But if you have co-ops they don't have, they don't try to seek the profit as their motive, right? So the taxation environment will be different, as I said before. If you have investor-owned utilities, then they're subject to tax, right? But if you have cooperatives, then they don't have any tax, right? So in that case, these things will be totally different. And so, you have to be careful about selecting the comparable groups. Okay, and the capacitors and all this, the weather certainly seem to be important as well. Why weather is important? Because the amount of revenue and the pattern, depends on the weather as well, right? Because the utilities nowadays, the weather is a very important factor. Okay, I think this is probably last page. Yeah, last page for that. It's just quickly. I'm going to spend more time on the next one. Okay, the next one. All right, segment evaluation. All right, so we were talking about the company as a whole, right? As a whole, and generally speaking, how we're going to be able to evaluate the company stocks, right? The value of the company or any company. Here, what we are looking at is, let's just look at, because especially in the energy sector, we have company which could be integrated, right? Could be integrated, which means that you're going to have different segments. You have different segments, right? You have the E&P, you have a pipeline, okay, or you have transportation, right? Sometimes you have tankers, okay. How are you going to be able to evaluate these, right? Or pipelines? How are you going to be able to evaluate the pipelines? What's the worth of the pipelines, right? So look at each individual segments of the company. Right? So we have to, so for example, this is actually list some of the segments. Okay, ONG reserves, right? So how do we evaluate the reserve amount, right? What's the value of that? Okay, and then acreages. That's another one. Remember that we actually have standardized items, right? Remember that from the 10K, we try to that gives us some kind of idea about the value, right? The net present value is essentially the net present value of the reserves. Now, how much that's going to worth? That's standardized. kind of measurement. That certainly is one thing. But acreages, how are you going to be able to evaluate their acreages, right? This company actually has 5,000 acres, all right, or 10,000 acres, okay? How are you going to be able to evaluate the worthiness or the the net amount, right? In that case, this is something we'll have to. And we actually will have a particular section on that acreages, right? The acreages, that is, how we're going to be able to see, to determine the value of the acreages. All right, so, pipelines, okay, we have gathering, transmission, and distribution pipelines, right? So if you have 10,000 miles of pipelines, how much that's going to be worth, right? So what would be some of the general principles that we use to determine the value of it? The terminals, okay, tankers and the vessels. How much is that the oil tank, right? Sometimes we call it CC, okay, crude carrier. Right? How much is that? Right? So if the company actually, has 10 vessels, then how much that's going to be? Right? So we're going to look at that. Refinery. How do we determine the value of a refinery? And we know in the United States, we really haven't built any refinery since what? The 80s, right? For a long time, we really don't have any new refineries being built. Okay, what's the reason why? The reason why we just don't have any new refineries, we don't have any investment in the refining business. Right? So there's something we need to talk about that. All right? Obviously, this has something to do with the valuation of the refinery. Right? Because if we believe that have a high value, of course, we'll probably see the investment in it. Clearly, we just don't have very much value in building a new refinery. Okay. All right, so that's one. And of course, the marketing outlets, like the gas stations. Right? The gas stations. How much is a gas station? How much that's going to worth? And actually, the other day, my friend was saying, well, maybe we should get into that business, get into the just to buy a gas station, and then sort of, how much that's going to cost you? Right? How much capital you need to have? This is not like buying a little house, right? If you have $100,000, you can get into that business, right? But if you really want to get into that gas station business, you really have to have a pretty large amount of capital, right? As far as the individuals are concerned, we're not talking about big companies, right? Look at individuals. If you want to do that, how much are you going to have? You're going to pay $100,000, $1 million, $1.5 million. How are you going to be able to evaluate that? Okay, so we need to look at that. And the utilities, how are you going to be evaluated, right? Power and gas distribution. And these are some of the segments. So we're going to look at each of these segments, not all of them, but mostly, okay? Most of the segments to see what are some general principles that we can use to evaluate, to see how much that's worth, okay? How much that's worth. All right? Okay. Components about these are the things that we're going to look at. Okay, basically, prove the reserves. Right, this is again, this is a special topic. Right, special topic. We're going to see that if we have this much of prove the reserve, how are we going to be able to evaluate that? And then we actually have a standard method to assess the value of the proved reserves. Right, this is maybe the unit 13 or unit 14. So we're going to look at that. And then we're going to look at the acreages. The acreages, of course, there are a lot of details method, in doing that. But many times, what we're going to do is essentially use the comparable kind of sales, right? Say in this particular place, that if you have certain amount of acreage sold, and just recently we finished a transaction. Now then you're going to say, well, this time we're going to probably have the similar cost, right? As long as they are in similar locations, okay, the conditions, geological conditions are pretty much similar. Then the acre, we should probably have $10,000 per acre, okay, or $20,000 per acre, right? But in the last some years, then it doesn't really worth that much. Probably just a few $1,000s an acre, right? So this is how much actually we're going to have to pay for that. The pipeline is also one section we have to look at it. Tankers, oil, and LNG. Tankers, so with refineries. So we're going to look at 5 segments, okay, 5 segments. Again, I have to say something about this, all right? As you look at that, it's just a lot of times it's just a very, very rough principle. Okay, why is that? Because any of these things here is a specialized business. Is a specialized business. If you really want to get into one of these, now you got to have a lot of experience. You got to know exactly what's going on in the industry, in a little detailed things. right? So for us, I don't think we will be able to get into that much of detail. Right? So for us, what we can do is just look at the general characteristics, and then some of these things out there that we have to consider. Right? Again, there are some companies, for example, the vessel, right, like the tankers. One of the slides actually listed that, the website of that company. That company is specialized in evaluating oil tankers, right? So if you really want to do that, there are not that many companies actually who specialize in that. Just a few companies specialize in evaluating the oil tankers. Right? So if you want to buy an oil tanker, how much is it going to be? You better hire that company, right? Hire that company to do that for you. So that's pretty much. And other people, they don't really know the business. They really cannot come up with a very good idea, right? The number for the worthiness of that particular, like tank, or particular tank. All right. So the acreage variations. All right. Some is the idea. 10K has the information. We already seen that. We have already seen that the company actually has provided that. But the problem with that is the market value. The market value of that is really, really hard to determine. Because many times, what's the market value of the acreages? It depends on the price, right? The market price. And the market price changes. And it also depends on the projected output, right? So a lot of times, these things have considerable amounts of uncertainty. Right? So this is really, really hard to estimate. In 10K, we have net developed acreages, not underdeveloped acreages. This is reported there. All right. All right. Let's see here. The fourth bullet point says in a mature and a well-balanced portfolio of ONG assets, the average component usually will represent about 20% of all portfolio value. Okay. And this is actually very important here, right? The last one is that the value depends on several factors, right? Several factors. How much that's going to be, and it can become very technical, very technical. Well, let me use this. All right. Okay, so this actually gives some. These are some of the numbers that are from the past. Okay, some of the typical type of the cost or the value of the acreages. Now these numbers represent the values from 2008 roughly to 2011. Okay, because nowadays I do not have 2012 here, 2013 here. Why? It's because nowadays the price is actually being up considerably. Okay, it's up considerably. So we have onshore and offshore, right? And in the U.S., we have low, most likely, and high. So I have three numbers there, right? That's three numbers here. Okay, I have three numbers, 1, 2, 3, and this is international. So it's not aligned, exactly. So look at the high side here, the bloom area, active area, right? So we have onshore, and the moderately active area, okay, inactive area. So the prices could be different. Offshore usually is a little higher. Okay, it's a little higher. Offshore we have $5,000. I mean that's kind of price in the last several years. Okay, typically. I think we have several other things there. All right, so the acreage value depends on the price of oil and gas substantially, which is easy to understand. Okay. Some of the transactions we have here, I have listed some of these things right, from 2011, 2012. Right, look at the Triangle Petroleum. They spent us $300 million. I mean, I just grabbed some numbers from the actual transaction. Give us some kind of idea about how much they paid, right? It's typical kind of numbers, right? Of course, depending on which location we have. All right, $300 million purchase of $86,000 acres, which amounts to about $2,800 per acre. Okay, now that's kind of typical. I will look at some numbers I compared to before. Northern Oil Company, $1.25 billion, 180,000 acres. That's the amount, about $4,000 an acre. Right? So I forgot about exactly which year, so that's why I put in there as 2011 or 2012. Now, this is not really a long time ago. It's not 2013 definitely. I believe it's probably last year or year before that. All right, so, okay, so basically the U.S. Energy, the company actually paid about $3,100 an acre. Right? So, but then the more recent transactions, especially 2013, actually cost a lot more now. Okay, costs a lot more. Right, so actually I have a pretty, there's no time. We don't really want to read that, this thing here. This is actually a news report from June 3rd, 2013, right? And one thing we want to look at here is they paid about $660 million. Okay, for how big? 42,000, right? 42,000. And this actually amounts to a pretty large number. Do I have a number here? I don't have it calculated. Okay, I didn't have that calculated. I think this is a pretty big number.
15,000.
18,000?
15,000.
Oh, 15,000. Yeah, 15,000. So it's pretty large. It's much larger than what we had a few years ago. Okay, because I was kind of looking at the notes, and some numbers out there just like kind of small, right? But then look at the more recent transactions. They are pretty large. Okay, pretty large amounts. Okay. All right, so we're going to again estimate to get the average value per acre and apply to the total acreages of a company for one particular company. If you can get into different types, if you have detailed information, you can do that. But if you don't, you just have to look at the total and then the average value. Sometimes it doesn't really, seem to grossly underestimate or overestimate value. You can get a rough number. So these are some of the numbers that are, these are, what should I say? These are actual transactions, especially this one here, the number. This is what we have here, right? So 2008 to 2010, in the Utica, in that the location. Typically, each year, we're talking about large scale. We're not talking about small ones, okay? Just large scale. Now, how do you define that? All right, it's like tens of thousands of acres, basically, right? So if you have that, average 3 large scale deals with the average cost less than $1,600 per acre. So if you got into that particular place early, then clearly you've bought this actually at a very cheap price, right? It's a bargain. It's a good bargain actually, if you have that. But then, like 2011, 2012, and you have average about 18 deals, and they average about $5,000 per acre, right? So you can see that the price actually went up significantly compared to some of the early years. Of course, when you got in there, you wasn't really sure there's considerable amount of risk, right? So, obviously the price wouldn't be high. But then later on, obviously we understand that there's a pretty large amount of reserves, right? So you know that there would be worth a lot more, right? And price obviously is going to go higher. So 2013, for example, this is Total. Okay, Total is a French company, right? The Total is a French integrated oil company. What they did is to purchase the 25% interest in this amount. This is what we call the net acres. Right? The net acres. Sometimes we talk about net acres versus the gross acres. Now, what I mean by gross acres, net acres, and sometimes sometimes you share some these acres with others. Then what we're talking about net is the amount that actually you are entitled to, right? If there's no others, of course, the gross and the net would be essentially the same. So this is the amount here, the acreages, and then $2.3 billion. That amounts to about $15,000, which is similar to the one that actually we just saw from the previous one, right? So it's 3 times on average, basically, right? 3 times more than the earlier amount that companies paid. So clearly, the acres could cost a lot of money. Now, this amount can decrease, right? This amount can decrease. It depends on production amount, depends on the price of oil and gas. But if you want to buy a gas, just basically buy the acreages for producing gas, the price wouldn't be that high, right? Mostly this time it is oil. The oil actually, because the oil price is still considerably higher than the equivalent gas price, right? So if you have huge amount of oil reserve, estimate, certainly that is going to be priced a lot higher than the acreages for gas, right? That just quite obvious, right? Because the price is the price. But nowadays, of course, if you look at the gas and the oil, right? A lot of times when you produce oil, we have associated gas. And for example, like in North Dakota, and one of the things that I just read about is that look at North Dakota, they produce a lot of oil nowadays, right? But they actually have a large amount of gas as well. It has a huge amount of gas. Okay, but the problem with that is we don't have a pipeline. Just same as like the Marcellus, right? Shell. In a lot of these places here, we don't have an infrastructure to get the gas out of it. Just imagine that if we actually start to build the gas pipelines and then collect these gas, now what's going to happen to the U.S. gas market? I'm sorry.
Well, the price is going to get down.
And price is just going to go no. I mean, essentially nowhere, right? I mean, there's no place to put it. The market price is going to be really crushed. It's going to be crushed. But just because of that, we don't really have any companies who actually have incentives to build the pipeline. Because the price now is actually pretty small, pretty low. $3.5 a MMBTU, right? I mean, this is not enough for companies to build a pipeline, invest that much, and then to get this gas out of it, right? So, so clearly, we're not going to probably see that much gas. But it depends on the places, right? If we are looking at the Marcellus, right, New York, this Pennsylvania area, and in the wintertime, we do expect that the gas price to spike because we couldn't get the gas over to some of the users in the New York area, right? Then there may be some incentive actually to build more pipelines, but get the pipeline to North Dakota, that's going to be pretty hard to do that, right? Because the cost of that investment is going to be considerably higher, and given that gas price, nobody probably is going to have enough incentive to do that. So, all right. Okay, let's look at the pipeline, right? Pipeline. The pipeline, basically, look at the transportation cost. The oil products, for one thing. I think this is some stuff that I got. Not very updated. Okay. Again, it's not very outdated either. So it's just probably a few years ago, if you look at that, right? And look at the oil product. If you transport from Houston to New York, it's about $1 per barrel, right? And then gasoline, just a few cents. Transportation cost is very, very low. Okay, very low. And if you look at gas, usually it's just a few cents, up to 10 cents, 12 cents per MMBTU transportation cost. So transportation cost is not terribly high. Okay. On the Trans-Alaska pipeline, obviously I did not put that number. How many dollars per barrel? I forgot. I should put that in. Now I don't remember that. So it's relatively small. Okay, so transport capacity, it depends on the size of the pipelines, right? For example, if you have 48-inch pipeline, it's pretty strong. That's the largest one typically. Okay, 48, it's pretty large. 4-foot, pipeline. That's conventionally, that's the biggest. And the 36 and 32, we can just go from there. If I have 48-inch, typically capacity is about the amount listed there. In 1 year, it's about 17.6 TCF of gas that can be transported, right? And for the oil, 48-inch, it's about 1,000 to 1,450 million barrels of oil per day. Right? So I'll give you that amount. And then the cost actually depends on the size of it, right? So if we look at some typical construction cost constructing the pipeline, inch mile, North Sea is about $100,000. I mean, of course, this is a little bit of outdated now, right? Nowadays, the cost could be a little bit higher. So in 2011, for example, the shale gas pipeline cost increased quite significantly compared to a few years ago. I forgot about the source, right? For example, it's about $200,000, okay, per inch mile. Marcellus shale is about $300,000 per inch mile, which means that if you actually build a 10-inch line, right? 10-inch line. That's pretty small, right? 10-inch line. Typically for a load distribution, right? Not the transmission. And it's going to cost $3 million a mile. Typically $3 million a mile. Bigger ones, and it's going to be a lot more costly. All right. Now you can go into the pipeline and the gas journal. They actually have a list of the some costs, information there. So rule of thumb for pipeline valuation. So if you have 3 miles, you have a mile. Typically, it's going to cost $3 million. Typically, right? Typically, but again, depends on location. Depends on the time or the price may be slightly different. By the way, these numbers are not really terribly wrong. For example, last year we actually had a siting project. Okay, siting project. So we were trying to decide where we want to put a gas plant, okay, power plant. Right? We were actually doing that. We were given 5 or 6 locations basically. So these are the locations that the utility was thinking about putting a power plant there. And obviously there are a lot of different factors because it depends on how close that plant is to the pipeline, right? And whether you actually have a station, whatever, you have a hub. And sometimes you actually have a location which is very convenient in terms of other factors, but that may be a little bit further from the pipeline, right? So in that case, then you're going to actually have to construct a pipeline, connect the gas from the main transmission pipeline to the plant, right? So we really have to put in the estimate. We have to put in the cost of constructing. I believe the number we use is about $2 million per mile, because we were thinking about a 20-inch line. That would be good enough. Just get that gas, right, from the main line to the plant. 20-inch usually would be good enough, for that kind of production, right, for a 300 megawatt kind of power plant. And I think what number we'll put in roughly, just rough estimate, right? It's not the actual construction cost, right? So we use about $2 million per mile. So just add on top of that. So give us some kind of idea about how much that's going to cost. So, for example, if we look at the chevrons, right, the U.S. International Pipeline mileages for year 2000. Now these are the actual numbers for year 2000. Right? We actually have crude oil lines and then domestic line mileages and then the international ones. This is the total amount, right? So if you look at crude oil, gas line, product line. Now, by the way, these lines are, if you look at them individually, they actually cost differently. Right? We're going to look at some of the detail factors. The crude. This is not. Sometimes they can convert. Right? If you convert it, that's fine, and that wouldn't be that much of a deal. So the total mileage is actually will be 87.21. If you use the $3 million per mile, then that worth $26 billion. Right? $26 billion. That gives us some kind of idea about how much that is. Okay, how much that is. Okay, maybe this is a good point to take a break. Any questions, comments, guys?
Wasn't that natural gas pipeline from Prudhoe Bay going to run around 22 billion to bring it down to 48?
I forgot the numbers, stuff like that. Yeah, that was quite substantial, But the gas pipeline, I don't know when they're going to construct that. Given the price, they may never construct it because we really don't need it. Right? We don't really need it. But you never know, right? It's just change, especially in the energy industry. The energy industry will have a boom bust, right? Why do we have a boom bust cycle? I mean, just look at that, right? The gas, oil price, look at the oil price. Oil price in the 70s, actually the price got very, very high. But then in the early 80s, right, the price was very, very high as well, early 80s. Because of the high price, everyone started to invest. But then in the second part of the 1980s, the price is essentially dropped like a rock, right? Got to a very, very low level in the late 80s, but then started to go up. Nowadays, what happened? This is the boom, basically, right? The boom period, because the high oil price. So a lot of people or a lot of companies are investing in the oil sector. What's going to happen later on? We're going to have a bust. I mean, this is kind of because technology turns that oil industry, the energy industry, to go through the boom bust. Right? So you guys actually going to you still have very good job prospect at this point, right? I'm not trying to, jinx it or whatever. But it is true. I mean, the high price, whatever, so you have very good markets. But actually, we probably have, I don't know when this market is going to come to the end. You probably start hearing things like that, right? Have you?
No.
No? Okay, this is good.
I don't think with the development of the undeveloped countries, and the rate that they're increasing the use of energy, we're going to see the same type of trend.
To what? I'm sorry, what's
I don't
that?
think we'll see the same trend that we've seen in the past because
Yeah.
of the amount of developing nations and the amount of consumption of the actual energy we're using, like between China, India,
Right.
and Africa, and Middle East, everybody, there's a lot.
There's a lot of demand.
They figure, you'll see 17% increase in demand for like the developed world, but you'll see an 80%, almost 80% increase around the world. So I think
It's going to
we're on the
continue.
right business.
Yeah. I hope that's the case. Going to have substantial increase in that. But people were talking about a slowdown in China or some other countries, part of the world, right? If that ever happens, then the demand may not be as strong as that. But because of this, then we have a huge amount of supply, right? How big is our procurement engineering program nowadays, right? Compared to a few years ago, and some years ago, like the typical size is about 100, 200.
The freshman class is over 200.
That's in the past or now?
No, my class graduated 80 last year. The incoming freshman class is over 200 students. Just
Graduated 80, roughly, right?
It was 80 in 09 as well when I graduated.
Okay. I don't know about next few years.
I think it's like 140 this year.
I think the thing is that the size actually increased quite substantially, right? I mean, the last several years. So everybody's trying to rush into that, and then what happens later on? And I think one of the things that I overheard it that Provost Mergel actually was talking about the program reached probably the top. Okay. Then I don't know whether the size is going to continue to increase or not, right?
They're increasing some of the requirements.
Texas A&M cat letters, nationally sound letters to tell people to make sure this is really what they want to do.
Okay.
Reconsider.
There may be a reason for that, right? Maybe just there could be oversupply just a few years down the road, right? I mean, this is always the case. I mean, this kind of economy, right? The market economy is always driven by the price, right? The invisible hand. So clearly, the gas industry is one example as well, because the gas, look at the price there, right? Well, the price is so low, why? We're the victim of our own innovations and our production, right? This is the reason why the price is very, very low. But then after some years, I don't know when the price is going to be depressed, because now let's look at the market analysis. Nobody's saying that the gas price is going to be higher than $4, right? Everybody's saying the gas price, the right level is about $3.50 to $3.70 at this point here. Because we really don't see any factor not going to push the price to north of $4 at this point. But you never know. If we actually end up with a very, very cold winter, the price may actually spike past that $4, right? But at this point here, given a normal situation, we probably wouldn't see that. I wouldn't really see that kind of thing. So the price tends to be pushed down by a lot of the production amount. So the cycles are going on, goes on. All right. Let's take a break. Okay, let's see. Pause. All right. Let's get started. Oh, can I borrow a piece of paper for the class attendance, please? Thank you. All right.
Go ahead.
I think the trick-or-treating is largely over, so we might stay here a little longer. So, actually, we still have our kids knocking at our doors at 9 o'clock, 9:30. Sometimes we'll turn off the light; they're still knocking the door. The doorbell, stuff like that. And in our neighborhoods, we have cars all over the place. They park every single space. It's hard, I just don't want to go back home at that time, because you're not going to be able to have a space. Actually, you can't really even get into your driveway sometimes. You don't want to boss that in. But this looks like a fake. So. Otherwise, people wouldn't lose it. Okay, all right. Now let's get back to, let me see here. Back to what we were talking about. Oops. Pipelines, okay. oh, we still have about 40 pages. I think we can do that, okay? I think we can do that. All right, because we don't really have a lot of these calculation or things like that. All right, so these are some of the pipeline costs and projected natural gas pipeline cost. All right, so that is from FERC, compiled by Oil and Gas Journal. So we're talking about how much that's going to be, and you can see that the price actually spiked in the years prior to the recession, right? Because we actually had, oh, I'm sorry, yeah.
Oh, it's okay. Just wanted to double check on inch miles. That's saying if it was 8-inch pipe, it'd be 8,000. The units there?
The units, okay.
1,000 per inch mile, so if it was an 8-inch pipe, it'd be, what, 8,000 per mile, basically? Is that what that cost is saying?
That seems to be, what's the units here? For this one, we don't have it. I know what it, yeah. $1,000 per inch mile. That seems to be right?
I would imagine that's what it is. I just want to check.
Okay, let's see here.
Material anyway.
Yeah, let's see here. Yeah, that looks like it's kind of low. We said, this tends to be the inch mile, right? We said $200,000. Let's see, it's 1,000. Clearly, that doesn't seem to be right. This is, well, let me see here, projection cost component based on trend from 1993 to 2004. Try to remember which year this was made. Okay, actually it's based on a large diameter gas pipeline, 30 to 36 inches, so it's pretty large pipelines. It shouldn't be this much though, right? It should be more than that. I mean, look at the numbers there. Oh, I see what I meant, okay. Yeah, the unit is $1,000. So if you look at this one here, it's $100,000. Okay, I was thinking about it. $1,000 per each mile, but that's the unit. That's what you meant, right?
Right.
Okay, so I mean the projection here was made a little early, right? This is the point where we actually had it. Look at that, right? 2008 at that point. So they were talking about $90,000, $80,000, $80,000 per inch mile.
I guess my only question was, does that mean that if it's $80,000 per inch mile, does that mean if I wanted to install, say, 8-inch pipe, that it would be
Times 8.
80,000
Times 8.
right? Okay.
Yeah.
That's all.
Oh, okay. Yeah, sorry, I didn't understand your question.
That's all right.
Yeah, I was thinking about it. This is 1,000 centimeters. Okay, I didn't look at that. The scale here. Yeah. So if that say it's 100,000, right?
Yeah.
If we have 30-inch, that's what I would say. About $3 million per mile. Basically, that's what it is, roughly. Okay, so the projection seems to be a little low in general, right? That was made in 2008. Because these things change. And many times, if you look at long-term projection, like how likely that's going to be exactly right, it's pretty tough. Right? So, anyway, okay, general characteristics of pipeline evaluation. So as we emphasized before, that is specialized. You really need to have a special firm that works in that area to do a good job. Okay, so we actually have different things. All right, so let's see here. No two pipelines are precisely the same. So you're going to have to consider specific details or some characteristics. So here we actually have some of the general principles right after that. Let's just go through that. All right. So when placing a value on the proposed existing pipeline system, right, we need to think about several factors. Right, several factors. The ATF method. And a lot of times we use that method, what we call across the fence method, right? Across the fence method. We use that method to assign a value to pipeline right away. Okay, right away. But of course, right away is not the value of that, because we have to have some other things added to that. It's not just the land price, right? So we can look at that. Some of these the need, why we sometimes have the need for pipeline valuation. A lot of times we're talking about the valuation of the company, right? This is part of that. But we actually have a lot of other reasons for why we need to evaluate that. So here a list of several of these things, right? Salvage value, or preparing for pipeline use conversion, things like that, right? Sometimes you have to come down to a specific value of them. So there are several methods. So I'm going to introduce several pipeline valuation methods generally used in the field, right? Generally used in the field by the specialized companies, right? These companies actually use these methods, the standard ones. The first one is market analysis, right? So you look at this is just like a real estate market, right? You look at the comparables, look at what is the value, what is the sales going on in the market. So that's what we meant by the market analysis, right? So value land, housing, but each pipeline is so different. So sometimes it's not so useful because the conditions in this pipeline may be substantially different from the other pipeline. So we have to look at a lot of specific characteristics. So this is not very much used, right? The market analysis. Comparable, sometimes we use that. We don't use that for a whole lot. Okay, the highest and the best use, and the general principle is that sometimes the pipeline has a lot of different uses, right? So they come up with a lot of different way or different values. Okay, different values. So for example, pipeline can be converted from a crude pipeline to fiber optical. Okay, and for electrical power lines, you can do those things sometimes, right? So you might want to just get the so-called combine the highest and the best value, some of these. All right, so combine all the different factors. Let's see here. Okay, seller determined need or book value. So sometimes we'll look at the book value. I think it's fairly self-explanatory. Let me see whether I need to. I think there's not much we need to explain here. Income-based or cash flow method. Now this is something that, let me just push this up a little bit. Okay. All right. That's based on the income of the pipelines that generated. Right? So cash flow. So this is stuff like we had before. And one thing is use a multiple of current cash flow, where the average annual cash flow is multiplied by a factor of 5 to 12. So we are using the multiples 5 to 12. So because we are considering the discount value, discount present value. So you actually have a stream of cash flows. Instead of just calculating specifically, just get a factor, right? Factor of 5 to 12 and then multiply that. So the example is that if we have income, right? The income is about $200,000 a year. Then we use 5 times, so it's about $1 million worth of it. Okay. So that number gives us some kind of rough estimate, because it's not very, very precise. Because even though you have some precise estimate, that's going to be based on a lot of assumptions as well. And so construction cost, and what's the cost of building a new pipeline, right? Same size, same manner. So how much that's going to be. That sometimes the company use that method to do that. Okay, also discount it. Not much to say there. All right, so what kind of factors that would actually determine the value? So we actually have a lot of different, the business value, physical value, property value, and the commodity values, some of the values. The business value, we look at how much throughput we actually have, right? Transportation, what's the income level? Supply, but the supply and demand factors, availability, and then buyer and the users. These are, again, very, very, very straightforward. So I'm not going to go through the details of that, right? Because when we read that, we understand that. Physical characteristics. Then we have the type, years, construction, appearance, size. Okay, a lot of different things there. Right? A lot of different things. And the property value, we have to look at the right-of-way agreement, okay? And maintenance record, all these things. There are several of these factors sometimes we have to consider. Which means that if you are looking at a detailed valuations, you really have to list all these things and give a number to that, all right? So just again, the principle, all right? Commodity value, we have to look at the price of the commodity transported, because that determines the valuation, the value of the pipeline, right? So that's probably one of the most important factors. Question. All right, and proximity to the markets. These are just some general things. Right? So let's just move on to the oil tankers. All right, oil tankers. So that's a typical oil tanker. Okay, typical oil tanker. And usually the size oil tanker is measured by DWT, right? The deadweight tons. Right? So how much actually the cargo is fuel, water, storage that the storage that this ship can actually carry. And the one long ton is approximately 7.5 barrels. So if you look at that, and we have of course long ton and short ton. There's a conversion there, right? Tanker types we actually have very large, ultra large. Okay, so VLCC, that's a standard term that are used in the shipping industry. Okay, the oil tank industry. So VLCC, right? So it's about 175,000 tons. Okay, CC is crude carrier. So crude carrier. Okay, ultra large, ULCC, ultra large. That's 300,000 tons of it. Right? So you can ship up to 3.4 million barrels of oil. So it's huge. It's huge. So actually, you can get some information from the website, right? So in general speak, we have more than 33,000, okay, tankers in the world with capacities greater than 10,000 DWT, right? And 40% of these actually came to the States, shipped called the U.S. ports. All right. And for example, like the ports on the East Coast and the Gulf Coast, deep enough. So what are we gonna do usually? They just have little load off, and then sometimes they come down to the port, right? Because it's not deep enough. All right. This is what I meant: offloading or lightening. Okay, lightering facilities, partial lightering. That is, allow tankers to sell directly to U.S. port and offload the bulk of the cargo. So here the valuations. I mean, basically, when you look at the valuations here, it depends on the size of it, as you look at that, right? It depends on the size. Small, mid-size, and very large, ultra large. And these are typically the value of it, okay, value of it. The small one usually costs about $50 million. And then the largest one could be $150 million, right? $150 million. Now there are some kind of general trend here. If you look at that, we actually have some of this new price and the old price. Here I have a list, and actually I got from the Wikipedia. And depends on the size of the and different class, okay. And we have the price of the the new and the low. You could see the upper could go up to 120. This is over $100 million, over $100 million. But again, the oil tanks are not the most expensive tanks out there. And one of the things we actually in the later slides we're going to see that the LNG tanks are the most expensive tankers in the world, right? It's the most expensive one. Right, so these are not. Are some of the basic facts. Okay, some basic facts. Because why we use this? Because we actually don't have pipelines. A lot of times you have pipelines going from Russia to maybe Europe, right? Okay, gas pipelines and the oil pipeline. And now, if you want to transport it from Middle East to the United States or Asia or a lot of countries like that, right? The way to do that is essentially go through the tankers, right, by the sea. So we have to use that to transport oil. Very large crude carriers. We have actually about 600. Okay. Data returns. This actually is kind of interesting. Look at the numbers there. Right. Data returns. That is how much actually you're going to return. How much you're going to make, or net income if you actually have a very large crude carrier. Right. It's about $10,000 a day to $100,000 a day if you carry oil, right? This is basic kind of a return we have in 2004. Now that value actually doesn't mean that nowadays we actually highest value. 2004 actually has the highest value in that time. At that time, okay, it's actually amount to about $100,000 per day. So you can calculate how much it's going to be, if you use that a year round. Right? So now we actually have a large world fleet of crude carriers. Therefore, the price of tankers has been pretty much depressed at this point here, as we said here in the first bullet points pointing out. Right? A lot of these ships were valued at the demolition price. So it's very cheap, generally speaking.
How does a VLCC ever pay off if you're getting only $100,000 a day max?
Okay.
It's like $360,000 a year.
260.
Is it just because it just maintains a lot of its value? It's not.
Well, yeah. Well, they don't really depreciate that much. But I mean, they can use that for many years. That's one of the reasons, right? Think about that. Just think about that. We have $10,000 a day, right? 365. So we actually have about 3.6, just say $4 million a year, right? Yeah, we look at the lower end. Yeah, $4 million a year. But if we actually have a high price, that would be $40 million a year, roughly. Yeah, $40 million a year, that's not bad, right? Yeah, you probably just got off by 1 0. Yeah, so that could make a huge difference, right? You have $1 million versus $10 million. I would retire if I have $10 million. If I have $1 million, I'll keep working probably until 85. So yeah, that's probably. So it still can have a pretty decent return because this is the income. Right, so. All right, so now it's just we have too many of these. That's why the prices are not that high. The prices are not that high. And okay, LNG, that is a little different. Now we don't have newest data, unfortunately, about the vessels delivered. Okay, so if you look at that, we don't really have that many LNG vessels, right? LNG vessels, and we actually have a pretty large need nowadays. And as we showed, because we actually have this shipping to different places, especially now. I used to have a lot of LNG shipped to the United States. That's why we actually have receiving terminals, right? But now, of course, we are trying to convert that receiving terminals to the exporting terminals, right? Because we have a lot of gas, so we want to export it to the foreign countries. But if you think about the Asian, right? Southeast Asian countries, they don't really have a lot of natural gas in that case. They're still trying to receive huge amount of gas. Most of the gas, natural gas for LNGs, were actually going to Japan, China, Taiwan, this Southeast Asian countries. They receive huge amounts. Okay? And a little bit actually would be diverted into the United States in the past. But now the import amount in the US actually has been reduced substantially. Right? So not a lot of LNG ships are coming to the States. And then most of these are still going there. Now, and again, of course, we are trying to export some things as well, right? Where are we going to export it to? Mostly Asian countries, right? Asian countries, Southeast Asian countries. And why? Because their price is still tied to crude. Their price is tied to crude. We here, our gas price is not tied to crude.
Yes.
Okay? We'll give it a try. Let's see whether this is going to... maybe I will probably just bring some batteries next time.
So is there any idea on how natural gas exports are eventually going to help lift the price?
Hopefully. Yeah, and people are actually expecting that to happen. But so far, sorry. Okay. Yeah, the thing is that how much we actually can export, right? And so far, we really can't export that much. We actually can't. Just use the pipelines to export, right? But the problem is that how much you actually can, right? We are not really exporting to a lot of other countries in the world yet, and the U.S. export amount is still pretty small. We still are importing a certain amount, even though the import amount has been declining. And as we said last time, the U.S. import amount actually offset the increase in production pretty much. Essentially, the total amount of available gas kind of kept constant at this point. Essentially, our increased production is replacing the exports. I mean, it's replacing the imports in that sense. We are not really exporting that much yet. We are hoping that we're going to be able to export a pretty large amount, right? Once we convert these export terminals, import terminals into exporting terminals, and we have constructed pipelines to say Mexico, for example, right? We can export gas to Mexico in that sense. Yeah, I'm not going to use that anymore. So. So that's going to have some pressure on the gas price.
How long does it take to convert these terminals to export?
You guys probably know better than I do.
I have no idea.
No idea? I have no idea either. So, yeah.
Teachers.
It's going to probably take a couple of years at least, to do that. And I probably should have known. I should have read about this because, the things that I read on a daily basis, they actually have some information just because I don't really have all the time to read that very carefully, So they have something. I think it's probably going to take a couple of years, 1 year, a couple of years. I don't know. So that I better not say anything about that. So it's not like a few days probably. Well, there's one thing though, because sometimes it's not in the technical part of it. You need to get approval, right? That approval process can sometimes take quite a bit of time to get to it. So that could be a little problem. Anyway, so average price is $200 million. That is very expensive. That is very expensive. The most expensive ship in the world. Not these cruise ships, but this. Okay, refineries. Look at the refineries. So in the United States, we have about. I look at the variations. Of course, now it looks like we didn't really talk too much about the variation of the tanker stuff like that, right? I mean, this is pretty much it. To give like the basic idea. You're not going to get into the details of that. How much that's going to be, and just a rough estimate about the market price of the tankers, right? Because a lot of times the market price determines it. All right, but refineries, we have about 150 refineries in the United States in early 2000. And now only down from 319 in 1981. Okay, so it's been decreasing, right? Some refined for taking offline. Cause of decline, regulatory and environmental issues and low margins. Right? So it's not profitable. So essentially, it's shut it down. Regulatory, of course, we have a lot of these, you cannot have that much of the emission. So if you don't require, meet that standard, you just have to lose money proposition. Okay, let's see here. The U.S. demand to refined petroleum product began to decline after that 2008. Began cutting back capacity and in some cases temporarily idled or permanently closed the refineries. These are some of these that can happen in the industry. Let's look at some more. All right, so these are some of these. So we have this districts there, right? Okay, so Petroleum Administration for Defense District. This is what we call the PAD district. 1, 2, 3, 4, 5. Okay, 1, 2, 3, 4, 5. And look at the Gulf, right? Gulf Coast. Most of these refineries, look at that. That has the largest amount. Right? PAD 4, PAD 3, we actually have 44 here, right? PAD 3, and then 1 actually, and then 4, each has about 12, 15. Right? So the Gulf Coast is the one that has most refineries along. That's quite obvious, right? We all understand that. Okay, and then refining capacity, of course, is also the largest in the 3rd district. Right? That's the total amount of refining. Capacity. All right. This plot actually explains the capacity utilization rate. Capacity utilization. Of course, that determines the price of gasoline, right? Directly in that case. If the refineries are operating at a high capacity, close to full capacity, clearly the gas price is going to be a lot higher, right? So this actually is relatively 2012. We don't have any, we actually have the up-to-date 2013 information. So it's operating at close to 90%, 95% actually, right? And that also explains why. Remember that we said the oil price started to increase, right? Partially, one of the reasons was that the capacity. Okay, the refining capacity is getting closer to full. So that caused the demand for the oil price to increase, which reduced the gap between the U.S. crude price and then the international, basically the Brent price, right? So that has something to do with it because of the increase in the refining capacity in more recent periods, right? So, but as long as that, we actually can keep that operating capacity at a pretty high level, and it's efficient, basically has lower cost, and we really don't, this point here, we don't really need to probably increase the just investment in the refinery industry. Practically, we really haven't made any new investments. Okay. All right, so how do we evaluate the refineries? All right, basically, a number of ways. One of the things to do, let me see here, we have one, cash flow, and then multiple, these are the ones. All right. Okay, so basically, the book value. The book value is one of these things that people typically use, right? Book value multiple. So if you come up with a book value of the refinery and then use a multiple, and typically this is what we have, all right? So it's provided directly or indirectly on the balance sheet, of course, we know that. All right, and then the book value represents the actual construction cost or purchase price, right? That's the DD&A. Let's see here. On the basis of the multiple of, sometimes appraised on the basis of the multiple book value. And typically it's 1.25. So if you get the book value determined, and then multiply by 1.25, right? So that's pretty straightforward. Now in the down markets, you can sell as low as 75% of the book value. So the refineries are not selling at a really high price. It's actually pretty low level. All right, another one, of course, we look at the cash flow and the operating profit multiplier, right? Multiples. So we can get this information from 10K and everything. So let me see here. Refining and marketing segments are usually appraised at 4 to 6 times of operating income, or 5 to 7 times cash flow. So these are some kind of rule of thumb, right? The book value is about 1.5 times, and the cash flow, and then the operating income, we actually have a little bit more, 4 to 6 times, and 5 to 7 times. Right? So a little higher. Okay, there are some of the recent ones, right? There's some numbers for the recent sales, right? So recent sales, and the one that is the most important part is the last part here, because one of the reasons is that the refiners do not make a lot of money, right? So a lot of companies just want to keep it, they try to sell it, or either shut it down. So that caused the price of the refiners to decrease quite significantly, right? Decrease significantly. So one of the things you can see the last one is there. I think I can't remember that, right? This actually is more recent. It's more recent. So definitely after 2006, maybe like 5 or 6 years later, like early 2000, right? Only can get about 80% of the price they obtained in 2006. So clearly, the more recent thing is that the refiners are not getting that much. So they are evaluated at a much lower level, right? So there's sometimes this is something that we need to use in order to see how much actually the refiner is going to be worth, depending on the Nelson complexity index. All right, so let's just have. You guys probably studied that, right? Have you? Okay, not really. Okay, so if you study that problem, okay, relative cost. Basically, Nelson index is a relative measure of how many upgraded units that the refiner has, how much they cost relative to distillation capacity. All right, so basically, it talks about the relative cost components defined, because each of these refiners are a little different technically, right? And they have different components. How much then each of them would cost? We're going to basically get like the weighted average cost of the refiner. So we have different kinds of operating units here. Okay, so we're going to see what are some of these. Okay, the example. Let's see here. This example here. Suppose this is the one. Let's just go a little slower on this one. We don't have numbered it. Suppose that we actually have a unit that costs $400 per day. Okay. Per actual stream day, barrels per stream day. What is stream day? It is maximum number of barrels of input that the facility can process within a 24-hour period. Right. So that's of course the full capacity. So that is what we call barrels per stream day. Right. Stream day. All right. So we have $400 per barrels per stream day. Okay? Then a 50, of course, just needs to be equal to $2 million, right? $2 million. I just multiply, right? Multiply by. And then another component costs 1.2, 1,200 barrels per stream day to build. Then the complexity factor is 3. Now what do I mean by that? How do we calculate the complexity factor? Basically what happens here is that this $400, right, per barrel, per stream day. But then another unit actually costs about 1,200, which is 3 times of that. Okay, 3 times of that. So that's why we call that factor, complexity factor, to be equal to 3. Essentially, it is based on the relative cost, right? Relative cost. All right. So look at some of these things here. Okay, if we really look at how we can rate it. What is the rating, complexity rating of the refinery? Complexity factor for given unit times the percentage of crude oil it processes. So it's basically the weighted average. Right? We calculate the weighted average of that. So the crude distillation capacity is 50,000, and the vacuum distillation capacity is 30,000. All right. So what's the complexity factor? We actually have a complexity factor of 2. Then the contribution of vacuum unit to the overall final capacity will be equal to 1.2. Why we do have 1.2? Basically, this is used as, this is the base, right? This is the base we use, right? This is the base, 50,000. Then this actually we have 30,000. But then the complexity factor is 2. So this is equivalent to 2 times of the normal, right, crude distillation capacity. So even though it is 30,000 barrels per stream day, but we have factor of 2, which means this is equivalent to 60,000 barrels per stream day, right? So overall, this case here, then this is equivalent to 1.2 units, right? So 60 divided by 50,000, that's a factor of 1.2, right? So this is how we can actually calculate that to be equal to. And so that vacuum unit to the overall, it is 1.2, right? Because the average one, right? The average one is this. The average one is that. Okay, so basically for the U.S., the complexity rating for a refinery in the U.S. is about a 10. So if the rating is 12, what does that mean? The average is 10, right? If the rating is 12, then it costs 20% more to build, basically. Right? If the rating is 12, because the average is 10 here. The average, this is 12, so it costs more. So because everything, the rating is based on the cost, right? Based on the cost, right? So. And the duplication, the economy scale will set in, and that's going to affect the price. Basically, if you have 2 units, what we are saying here is that you have 2 40,000 units, 40,000 barrel per stream day units here, instead of 1, which one is going to cost more? Obviously, the 2 40,000 units is going to cost more, right? Because if you have 80,000 units, that's sure you have the economy scale, right? You have the economy scale. So basically, instead of 1, what that says, 2 actually will cost roughly about 20% more than a single one, right? Even when we actually have the same total amount of capacity. So, all right, so let's see here. A rating. Oh, okay, yeah, I try to understand that. Yeah, I put that in some symbol. So. Look at the capacity and typical the mid-continent. The mid-continent, this area, right? This is what we call mid-continent. Oklahoma, this is places the mid-continent. And capacity typically 45. Gulf Coast typically at this. The West Coast is 120. And then Nelson capacity, complexity index is a little different. The West Coast is a little high, right? So, that's a typical one. And oil and gas journals they actually have these ratings. And if we look at each of these kind of units, processing units, and the crude distillation, actually, as we said, that's the benchmark, right? We use that as 1. And look at all the other things here, and I don't even know some of the stuff. You guys know a lot better than I do. Okay? And these are some of the factors. Okay? Some of the factors that. All right, So you can, if you want to analyze that, you just have to obtain all the capacity index information, and then you use the average, weighted average as I said earlier. Okay. So next one, we're going to see, well, the last bullet section is very important. Okay. Last one is very important. Refiners will typically sold for a fraction of the replacement cost, typically 1/3 of it, right? And this is why we don't really have a lot of this, don't have any new refineries, right? Because it's not worth it. Right? It's not worth it. You can simply buy the old one, right? If you buy an old one, if you build a new one, it's not worth that much. So in the last several decades, we don't really have any new refineries being built. And look at this diagram here, so whether we can understand what that is. Okay. All right, so if we are talking about a vertical axis, the vertical axis is the capacity, okay, it's capacity. All right, so what we are saying is that we actually have a barrels per stream day. Okay, so that's the capacity here, and here we have complexity index. So the bottom part says here, if we actually have a capacity of 10,000 barrels per stream day, this is the one we have here, okay? If we are doing that, so 100,000, 100,000. So, I'm sorry?
Well, I'm just saying, it kind of tells you at the bottom 100,000, but it doesn't go up any higher than 16.
It's saying dollars per barrel per calendar day.
Oh, this is dollar per barrel. I didn't read that carefully. Okay,
Oh, okay.
I should know that better. Okay. Yeah, the dollars per barrel. So you actually have 100,000 barrels per day, right? So you have to multiply by that, okay, to get the amount. So basically, what we are saying is that 100,000 barrel per stream day refinery with a complexity index of 8. So index of 8 is over here, right? That's index of 8. We have a value of around $3,000 per. So how I got that part? Oh, this is what we are saying. It's going to $3,000 per barrel per stream day. Suppose that is the value for that. So 3,000, where is that 3,000? Probably the middle point here, right? That's what. That we are talking about transaction value here. That is the existing refinery. So the middle point here, right? It's roughly about 3. That was 4.
So aren't we looking at, you said complexity?
That's probably not reading that right. What?
Shouldn't we be looking at the line 8 to trace whatever is connecting to?
Index of 8.
Yeah, it says with a complexity index of 8, right? So
Yes.
on the line 8, we would have to hit something and then trace it back to the x on the y-axis, right?
Yeah.
I think it's probably just talking about the middle of the transaction.
Yeah, we're talking about this one here, basically. I was looking at the line. It looks like the 4,000 probably. Depends on the value, right? How you read that. So somewhere here, probably 3 somewhere here. You know, it's roughly. You know, there's a transaction value, roughly. Okay. So if you look at the table here, right, roughly about this much here. So say it's 3,000, maybe even 4,000. You can read that. This line here says 4,000. Okay, if I change that to 4,000, right? I'm reading this line here.
Okay, I'm not understanding. I know we basically figured out that it's supposed to hit somewhere around there, but if we didn't know the answer and we were given this graph, how would
Okay,
we
so
do
let's
that?
do this. Let's do that. Basically, what that says here is that if we are looking at an existing one, not the replacement one, right? The replacement one, we don't really have that much anymore, basically, right? It costs a lot higher. There's no new construction anyway. But this is factored up. So we have 2 things here. One is the transaction value. So we are looking at transaction value. The transaction value depends on the complexity here, factors here, right? So we are looking at a complexity factor of 8, okay?
So what
Yeah, the
line-
reason I did that is because, you know, I actually have to draw this line, so it's not very precise. That's probably the reason.
So which line represents the transaction value?
Probably a high and a low.
High and low, I should have said that.
So
This is low, this is high, So that's the range. There's a range there. I should have explained that. Yeah, I should have.
You could say high as 5,000, I mean, it's in there, I mean.
Yeah, the highest, because I use Excel stuff to draw, so it's not very precise. So, but I probably should have explained that
Screen
first.
probably a little smaller than this.
Yeah, so the low and the high, basically, that represents that transaction range. Because sometimes you know that it depends on the market condition, right? And the price could be high, could be low, depending on that. So pretty much, this for some, because this is the sales value has to be on the bottom here. So the middle point is roughly about $3,000 to $4,000, right, per barrel per stream day. That's why we have this one. That's why in the bottom part here I put down around $3,000. David, is that okay?
So the 100,000 barrels per stream day is totally irrelevant in this
That's
case,
what I was
right?
gonna ask,
Nope.
what does that have to do with
That's,
it?
that's what it puts out, so you multiply it by 3,000, that's the value of that refinery, right?
Yeah.
Okay.
Yeah, 300 million is gone down to the 100,000.
So, but as far as the graph is concerned, we're not at all concerned with the capacity of unless this graph pertains specifically to that refinery.
I probably said something wrong very beginning because the vertical axis is not really capacity.
Right, right.
Yeah. So this is actually dollars per barrel per calendar day.
But so, I guess, I think where the confusion is coming from is we're looking for something on that graph that has to do with 100,000 barrels per stream.
Oh, there's no 100,000 barrels here.
Right.
This is basically 1 barrel. This is per barrel.
So is this chart is not a standard chart for all refineries. This is made specifically for this particular refinery we're talking about that just happens to have a
Well, I
capacity.
mean, this actually you can view that as a general type of
I mean, you could put
evaluation.
it different, if it was producing 200,000, then we would essentially value it.
If you put 200,000, then it depends on what's your capacity factor here, right? Suppose if you have complex, let's just take a bottom point, suppose. Look at the lowest value here. At A here, lowest value looks like it's about $2,000 per barrel, right? So if you have 2,000 barrels per $2,000 per barrel per, this is calendar day, so it's not really a stream day, right? So it's a calendar day, it's not going to be so much different.
I thought calendar day was stream.
It's not exactly the same. It's not exactly the same, the stream day. They define slightly differently. Slightly differently.
So
Okay.
what's the difference?
I don't know exactly the calendar day is probably from 0 to say next 0, right? Stream day, they actually have certain hour, not starting at the same time.
So it's less than a calendar day. It can't be more.
It can be more. Yeah. So I probably should have had the same kind of measurement. Okay. Same kind of measurement. All right. Just like a gas day, probably you can view that the same as, but it's not the exact same. But it's 24-hour period anyway. Right. So in that sense, it's kind of similar, right? I mean, like a gas day. What's the typical gas day? Gas day, calendar day. These are not the same thing. But we all measure at the 24-hour period. I don't really know when the stream day, starts. Like gas day. I'm sorry, David.
9 o'clock in the morning.
Are you talking about the gas day or?
That's when the gas station.
Yeah, the gas day start like 9 o'clock in the morning, exactly. That's the gas day, right? So 24 hours is 9 to 9, right? But the calendar day is 0 to 0. But it still mentions 24-hour period. I mean, what's the big difference? Not much of a difference, but typically, why we actually have a gas day? Because the nomination and all these things actually are involved. So the day begins at 9 o'clock. I mean, that's for the operation kind of convenience. The stream day. It's not going to be, the total amount of consumption, whatever process should be the same in that sense. And so if we actually have $2,000, this is the lower level. So this is very cheap at this point here. And if you have 100,000 capacity, basically how much that's going to be for the refinery, right? If it's 100,000 capacity, it's essentially just multiplied by 100,000. See what I mean? So the price of that would be 2,000 times 100,000, that equals to $200 million, basically, right?
So, okay.
That's the valuation of.
That is the worst valuation that exists in the refinery, given this range here. Which means that roughly goes from $2,000 to probably $5,000 in that neighborhood with that capacity factor. see what I mean, right?
Yeah.
So hopefully we have explained this. I probably should be a little bit more explicit at the
The
beginning.
100,000 should be a capacity, should be just a volume, or just a volume number.
This is just a pick a random volume number.
Yeah, but you have that as a volumetric capacity, so that should be 100,000, just 100,000 barrels multiplied times with.
Basically, what this number says, if 100,000 times $3,000 per barrel, that would amount to $200 million. So if you have such a capacity, you have a refinery that have this capacity, then that should be equal to $200 million. Okay? So then if you look at this part here, suppose this is the $5,000, right? At this point here. Then if you have $100,000 refinery, then the refinery should worth $500
We're
million.
engineers, we were focusing on the units.
Yes.
Now I'm an economist, so we look at the profit. Not so precise. Because this is what the market value is, right? It changes from moment to moment. And if today I don't feel good, this shouldn't be worth that much. But anyway, I mean, this thing here is roughly based on the market transactions. So it's not very, very precise, but give us some kind of general idea. So the capacity factor is a little higher, the value tends to be a little higher as well. But again, the range tends to be a little bigger, right? So that's basically what it is. And one point we want to actually emphasize is because the replacement value is a lot higher than the transactional value, then a lot of times we don't want to produce that, because, right? If you already made investment, then you sell it. It's not worth that much, so you don't want to build it, right? You build it, you sell it, it's not worth it. Okay, so. All right. Okay, hopefully we got that squared away. Okay. All right, so the gas stations. All right, so it's declining trend in number of gas stations, partially due to mergers. Typical gas station receives 50% of sales from gasoline. It just, of course, varies, right? It depends on the type of gasoline, gas station. Gasoline offers net profit on the order of 12 cents per gallon, roughly. Okay. Others probably have different profit margins. Profit margins tend to be higher. Okay. Convenience stores. These are some convenience stores, and we have truck stops and travel plazas, especially Love's, right? That's pretty good business. You guys probably know a little bit about a Love, right? No, not that Love, by the way. Okay. Today is not really Valentine's Day. I'm talking about what's his first name? You know what I'm talking about, right? Love's gas station. I think he is Oklahoman. Oh,
Yeah.
no? You guys have no idea?
Loves?
Yeah.
Yeah, that's Oklahoma based.
Yeah, it's Oklahoma based. I read something this long time ago about Mr. Love. Okay, this is actually a very nice name. He actually is, he's Oklahoman. Yeah, I think, long time ago, he bought one gas station in some remote area. Of course, I'm not really starting a rumor or something, okay? But this is from a recollection, what I had before. He started that, and then started to develop that business, right? And then he found out actually, travel all the country, he didn't find that many of these gas stations offer truck stops, So he got into that business pretty early, I believe. So he started, think about his gas station, it's always that truck stop, right? None of other smaller ones, it's always truck stop. And he expanded that business into a lot of different states. And I saw the picture actually. This, he's probably in the 60s or 70s or something now, and not very tall and
His name's
skinny.
Tom.
Huh?
His name's Tom. It was
Tom?
Watonga is where he did his first one.
Okay, yeah. Let's get a little more details in that case. This is a very interesting history, actually, related to that gas station. So, truck stops. If you really want to get into that business, find a Mr. Love. So, he might want to sell his. Okay. Valuation. There are a lot of the 4 different types of valuation methods. The asset-based. Okay, what is the fair market value of that? We usually don't use that a lot because we use not asset-based. A lot of times it's based on the earnings cash flow. So this is the second method. The income approach is the one that we use a lot. Okay, and then income approach, that is the one we use that, right? Capitalization for earnings, essentially look at the net present value, right, to discount cash flow method to evaluate that, okay? There's a one article, this is kind of a valuation article I uploaded onto the D2L. They talked about some different kinds of gas stations, right? So they actually how to come up with the evaluation. They look at car washes and everything, all different components as well. So it's not just the gas station. With the gas station, you don't just have a gas station. A lot of the gas stations actually have car washes and the other, the convenience stores and all that kind of business. So how to evaluate that? They actually have a little bit detail. Hey, that's it. We didn't know that. Questions? Okay. All right. I think this is going to be the end of it. All right. So you may still have a little time to go back home and then do a trick treating. Well, let's finish a little early today. So this is the earliest time we ever let you guys go. Okay, I don't have other things actually uploaded, even though I probably can start the next one, but I'll just leave that to next time. All right, guys. That piece of paper? Thank you. So I already had like 4 or 5 stickers. I don't really know. We don't have, we have
So she gets it.
Are you talking about that, right? Yeah. We have 3 left. I was thinking about how many units. There's 3
The first week of December, right?
Yes, for cycle. Before the
And then their mom and dad want to come get candy too. For their own dad.
I think they're doing like I just checked.
So we don't have a lot left. So we're probably have more frequent wait time, stuff like that, or trick-or-treating mid-late. Because I was looking at some that I have. Have 15, 16. The last one is 16. So let's see here. This is 12. I have 13, 14, 15, 16. Yeah, I don't think that is going to last that long, so I'll probably find some additional information. I know it's fine, yeah. I know you have this
We can just do it revision.
Yeah, we're probably going to do that. And if I go over to 2 topics in each class, that would just have 2 days. Thursday. I'll come.
You need to run away from classes.
I'm going.
Sure.
What time you get
All right, Dr. Zhu, I will remember next week.
That's okay, we have another week.
When I start working. So after this next semester, 2 nights I got my drilling lab, and then I got this class.
All right.
What's that?
All right.
Well, we're closing on the 20th.